Hello all y'all, welcome back to the channel. Today we're going to talk about gold and the intraday all-time high it hit today. Before we begin, none of this is financial advice, as I am not a financial advisor. Creating or updating a portfolio management strategy should never be taken cavalierly, and without a professional advisor who is familiar with your personal circumstance as your wingman. With that out of the way, let's jump in. Gold reached an all-time high today, charging to just over $2,050 per ounce before pulling back and closing $25 lower. This surge to a new intraday all-time high has been driven by multiple factors, including the prospect of rate cuts in the second half of this year, the weakening of the US dollar, and increased demand from investors seeking a safe haven amid global uncertainties. Taking a look at the long-term chart for gold, we can see how it has formed a notable cup and handle pattern over the last 2 decades. This pattern, which is highly bullish, typically involves a cup shape that represents a period of consolidation, followed by a slight dip forming the handle before breaking out to higher prices like we've seen so far in 2024. Gold's recent performance has confirmed the breakout from this pattern, which began forming around 2011, and it was nearly completed by early 2022. For technical analysts, this pattern points towards significantly higher price targets, with some predicting potential targets ranging from $2,500 to $4,000 per ounce. These are lofty projections for sure, but I continue to find myself drawn to the lower end of this range. Specifically, I'd like to see May closed out with a strong candle without a long wick, representing strong sellers in the $2,400 to $2,500 range. My near-term target is the area in yellow, where we would see price action take a breather for a few months, establishing a range between $2,200 and $2,300 an ounce. Then we are clear to move sustainably above current levels. There is another chart that I think is worth looking at, the US dollar. The value of the US dollar and the spot price of gold typically have an inverse relationship. When the dollar strengthens, gold prices tend to fall because gold becomes more expensive in other currencies, reducing demand. Conversely, when the dollar weakens, gold prices often rise, as it becomes cheaper for investors using other currencies to buy gold, increasing demand. This inverse relationship is influenced by factors such as inflation, interest rates, and geopolitical stability, with gold often serving as a hedge against currency devaluation and economic uncertainty. By laying the price of gold over the United States dollar, we're seeing this play out today. That leaves what I've been stacking for May. I tend to tack back and forth when it comes to buying gold, mixing some numismatic coins in with bullion. This month, I added these 2 1926 gold commemoratives celebrating the country's sesquicentennial anniversary in MS 64 Plus and MS 65. My thinking here, besides loving this low-profile design, is that with the semi-quincentennial approaching in 2026, there will be some appreciation in these pre-33 pieces as collectors take a chance to look at past anniversary coinage as they contemplate modern releases. Let's wrap things up there. There is no denying that gold is making a powerful move, setting May up as the 4th consecutive month of strong gains in a row. While these gains are great, I would like to see us give some back in exchange for the opportunity to build a strong foundation of price support. If we don't, I fear we'll find ourselves watching our stairsteps up turn into a red elevator shaft that we fall into and crash to lower prices. Thanks for watching. If you find value in today's content, please give it a thumbs up and subscribe. Cheers.